All right. Well, why don't we go ahead and get started here? There are, let's see, 4, 3, 12, 13, 12 of you. Um, actually, 13 of you. I see, Jake, you've got Dom in there, but you're both on the same team?
Yes, we are.
Ah, okay, okay. Welcome, Dustin. All right, so let me switch over here to my spreadsheet and let me jump out of the way here. All right. So let me kick things off here just with a couple of comments. And by the way, feel free to stop me at any point. Raise your hand if I don't happen to see it on the screen. Just unmute and shout out. This is a very informal setting. So a couple of things here. These spreadsheets that I'm going to be showing you and working with are spreadsheets that I'm not going to share. All right. And I have a method to my madness. And it's that however, I am going to walk through all of the details and so forth, and you'll have this recorded so you can go back and follow it. But my goal here is not to give you the actual template to do this without thinking about it. I want you to improve your spreadsheet skills. B, I want you to know exactly how this spreadsheet runs, and if you don't build it yourself, you won't know. So, and I guess C, I want you to make it your own. And there's always like in anything computers, there's like 5 ways to do anything, right? There's this button or that button, or you can do 2 clicks through here, whatever. So make it your own. Learn a little bit more about spreadsheets. Know the model that you're building. So, but like I say, this is also intended to try to help you build that model, knowing that some of the spreadsheet skills may be rusty, or maybe you haven't encountered some of the stuff that we're going to be doing here. And I think that's all I wanted to say at the outset. Any questions before we get rolling? All right. Very good. Actually, I'm going to change this view. I'm going to change it to speaker view so I can kind of see what it's looking like to you all. So again, if you do raise your hand and I don't happen to see it, please just shout out. All right. So I'm just showing you, I've got about 5 different spreadsheets in different levels of completeness. And so I thought that might be the most efficacious way to get this done without me making mistakes along the way and without wasting a lot of your time on this. But we will walk through everything. And so I'm going to start here with, this happens to be the balance sheet. And I just pulled this off of the current template when you go onto FA and the Bloomberg terminal and you go to balance sheet and just get the standard Bloomberg balance sheet. This is not off of that in-depth or that in-depth template that they have there. This is straight off of the balance sheet tab and the current template. So the formatting may be a little different than what you have, or feel free to go out and grab this. This is pretty easy. So I've already taken this and I've converted all of the formulas into values before I left Bloomberg, and then I saved it down to my local. I did the same thing for the income statement. And so let me go to my next sheet here. Okay, so the first thing that I wanted to do here was to kind of just get my formatting put together for what I'm going to do for the pro formas. I've used this. I've chosen to use this choose function, and so I set that up here. So this choose, we're going to have 3 different types of averages here. One of them actually isn't even an average; it's just the most recent year of financials. Here I'm going to do a 2-year average, so that would be the 24 and the 23 fiscal years. And then here I'm doing 5 years of average. So I'm getting the percent of sales for all of the income statement accounts, and then I'm getting the current accounts and the current liabilities as a percent of sales on the balance sheet. And so I've got this set up for my income statement. And let's see, let me go back over here. I'll zoom back out. So here's my income statement. And then the things that I'm going to be doing in the with the pro forma, the 5 years that I'm projecting will go out here. All right. And I've done the same thing with my balance sheet. Oh, no, I haven't. I lied. Sorry. It's not on this one. It's on step 2. All right, so this first spreadsheet is not particularly a big jump. Step 2, though, there is a fairly sizable jump in what we're doing here. So you'll notice that I've cleaned up my statements. I've consolidated them even further than they were consolidated when they came out of Bloomberg. And the rationale for that is that I don't have enough insider knowledge to be able to understand some of the sub-accounts that they have on their income statement and their balance sheet. And as a result, it really is meaningless to leave them in there. It just makes the statements more confusing. And my real goal here, now, when you do this out in the real world, once you're done with school, you would have a much more in-depth set of statements. And you would probably, at that point, if you've done this, if you've followed this company for a number of years, you'd probably have enough knowledge in order to have some priors about how some of the sub-accounts will interact as revenues go up or down. But at this point, again, back to the old, it's a 100-piece puzzle, not a 5,000-piece puzzle analogy. So simplify it, get rid of all of the clutter. So you'll notice here that I've gotten rid of, the revenue. I just have revenue at the top line. Then I have cost of goods sold down here. And then we go immediately down to gross profit. If you go back to the other spreadsheet, you'll notice that, it was cluttered up with these extra things that really these don't even add any value, right? They're just a repetition. This line is a repetition of this line, and this line is a repetition of this line. So here I was just cleaning up clutter. Further down here, though, for instance, like operating expenses, we've got SG&A down here, we've got R&D, we've got other operating expenses. And when I look at these, I go, oh, well, most everything is in SG&A, right? The vast majority of it is in SG&A. There's nothing in R&D, and then there's a small amount in the other operating expenses. So I've just collapsed that into a single account called operating expenses. When we go back to to this one, notice here just that single account, and I've got all of my operating expenses in there. And I'm going to calculate my percentages based upon that single account, right? So a 5-year average, that operating expenses was 20% of revenue. Over a 2-year average, the 23-24 fiscal years, that was 19% and 20% on the most recent year. So not much variation in their operating expenses anyway. So I feel okay about making that simplification, getting rid of those sub-accounts. And you should, follow that same thing. Also notice we go up here to cost of goods sold, and we've got 62% for the most recent year, 64 if we look back 2 years, and then 63 looking back 5 years. So what I'd suggest that you do as you're building this and as you're looking at how stable or not stable each of these accounts is, make sure that you've analyzed it and understand what's going on. There are some weird quirks that I'll point out as we go through this that you'll want to try to avoid. There were one-time events here that influenced a particular fiscal year that didn't affect the others and probably won't affect future years. So we want to try to dial that back out of our model because it's a idiosyncratic thing to that particular year. There was a large merger, right, that occurred back last year, and that kind of messes up some of our numbers here as we go forward. In fact, you'll notice here notice this is on abnormal losses and gains, right? Look over here at it. And by the way, is this spreadsheet big enough for you all to see? It's okay. All right, because I can zoom in and out. But so notice here under abnormal losses, gains, we've got small numbers for the most part, and then all of a sudden in 2023, boom, a huge value here. So that that was that merger, and over here then it's back down to normal. So we see if we do the 5-year average, you got 4%. 2-year average really gets thrown out of whack. It's 8%, and then the most recent was 2%. So make sure that you're kind of following through here and cleaning this up and understanding what all of the previous data looks like before you move on too far. Let's see. Let me just zoom in just a little bit here. And really, you'll notice that within just a few lines here, going down to right here, that's my entire income statement. So pretty simplified. The rest of this information we will look at and analyze, but nothing that we need to do with this down here. This is just supplementary information that's provided to us in that particular template from Bloomberg. All right. And then if we go over here to the balance sheet, you'll notice that I've done the same thing. I'm calculating these percentages and as a percent of revenue, right? Unlike a standardized, remember, there's a difference between doing this process, the percent of sales method of doing pro formas, and a standardized balance sheet. A standardized balance sheet is as a percent of total assets. Here, we're doing something a little different. So if you downloaded the standardized balance sheet from Bloomberg, that's not the percent, those aren't the percentages we want. The percentages we want are the percent of revenue. So these are all calculated as a percent of revenue. So here we have cash. 5-year average is 5% of revenue that we've had on hand. But again, notice that here we have an outlier in our cash accounts in the fiscal year 23. And so when I look at the 2-year average, it gets blown up. And then I look at the most recent, and it's quite low. So I'm probably going to pick something in between 1 and 5% as an actual number. And I may even change some of these just because I want to deal with this outlier right here, this 1143.60. I want to fix that and make sure that I don't have any difficulties there. Going down, we have... why didn't I put the payables in here? I guess I just didn't do it in this version of the spreadsheet. I'll do that in step 3. Now, let me go back to the formulas themselves. So, for instance, how did I calculate this formula? Well, what I did was I used the average function. And let me, I need to use this to zoom in. So I used the average function. And I took the average of the cash account, which is in column C, row 7 for fiscal year 2020. That's this guy right here, this 391.1. All right. I took that and I divided it by cell C6 on the income statement. Well, let's go over to cell C6 on the income statement. And we notice that cell C6 is our revenue for 2020. All right. So that's one element of that formula. The rest of them, and then a comma. And then I did the exact same thing for the other fiscal years. So D7 is fiscal year 21 divided by the revenue from fiscal year 21, which is D6 on the income statement. And then a comma, and then I did fiscal year 22, fiscal year 23, and fiscal year 24. Close parens, and my formula is done. And then since everything, you'll also notice that I've locked down for instance, I've locked down the row, but not the column in here. And same thing here, I've locked down the row, but not the column. And what you'll find is that then when I copy this thing over to the right, it will copy properly. Now, obviously, I'm getting rid of several of these to do the 2-year, but the 2-year is basically the same animal as the 5-year, just only two entries in that. And then the 1-year is simple, just a regular formula. I don't need that average function in there. So I've done that same thing all throughout here. That's how, notice how all of these formulas look. And, you know, as you're working on your spreadsheet, if you want to, you know, follow through on the video, you just stop the video and write your formula if you want to do this. Maybe you already know how to do it. But is everybody okay, you know, moving between sheets when you're writing formulas? Not a big deal? Okay. And then obviously the income statement is the same way. We've got averages, but here obviously it's simpler in the sense that, you know, I can more simply just add things together and average them. So here I've done the same thing with the 5-year, the 2-year, and then obviously the 1-year. The other thing to note on this spreadsheet before we move any further is that if we go back to our original data, which is right here, you'll notice that, for instance, on the balance sheet, we have, let's go right down to here. Under total current assets, it's just a value, right? And if you didn't do anything, you could just, you know, keep it moving just like you do with the other accounts. The problem is that if you don't code this a little differently, and you make some other changes up above, up above the total current assets part of the balance sheet, it may not be reflected down here. So what do I mean by that? Well, let's go back to step 2. So here I am I'm actually on the income statement, but the same applies here. Any of these subtotals, notice that the subtotal is not a value. It's a formula, right? So gross profit is simply revenue minus cost of goods sold. Now, on Bloomberg, when you download this is just a number. It's 2982.4. And yeah, you could build the model and use the percentages to calculate the gross profit. But suppose that I wanted to make a quick change, and I wanted to change something about the cost of goods, but I didn't want to change anything else. So I make that change. Now, if this is not a subtotal, it won't change. So my change stops at the first subtotal and never gets past that. So it never fully gets all the way down to the income statement, to the bottom of the income statement, to net income. So I always want to make my subtotals actual subtotals. So this is cell C6 minus cell C7. And then down here, again, another subtotal. Right over here. And you'll notice that this is simply C8 minus C9. And then we go down here, another subtotal. Boom, those guys go together. I've done the same thing on all of the balance sheet accounts. So when you look at current assets, it is a subtotal. Now, I happen to have left in here the sub accounts under inventory, not because I needed it, but I thought at some point maybe I'd want to adjust it. So I want to make sure that I leave any of those sub accounts out, because these two accounts right here add up to be the value of this thing up here, the total inventory. So as you're going through this, be very careful, be thoughtful about what you're doing, make sure you know what you're adding to or subtracting from as you do this. For instance, notice here too that I actually made this a subtotal as well. The inventories is actually a subtotal of raw materials plus finished goods. And then down here, again, I've got an actual formula in here as opposed to just a percent of sales. All right? Good so far? All right. So then let's go on to step 3. I thought I opened step 3. Did I open step 2 instead? Where are you? That's weird. This time I know for sure I did. I did it right. Let me try it from here. Where are you? That is very strange. Let me try just rebooting or starting Excel. I won't reboot because that'll cut us off here. And let's see, don't save. All right, let's try this and see. There we go. All right, now we're talking. All right, so I've done quite a bit of work in between the spreadsheet that you saw that I've labeled as step 2 and this one as step 3. This is really where most of the work gets done. Between this one and step 4 is where most of the work gets done. So I've made this a little prettier. I put some highlights on it just so I know what's going on. So on my balance sheet, these are the accounts, the current accounts that vary spontaneously with changes in revenue. So these are percent of revenue. And down here, I've got my percent of revenue for payables, short-term debt, and other short-term liabilities as well. The rest of them I'm going to come back and deal with at a little bit later point. Oh, one other thing I want to point out to you is to use this choose function. It's kind of a handy function if you want to have some flexibility and be able to easily move from a model that uses one assumption to a model that might use a different assumption. So, I have 3 possible choices here that I've laid out for ourselves. And so depending upon what this value is right up here, it will be either column 1, 2, or 3 as I've labeled it here. Actually, it's H, I, and J right in the spreadsheet, but I've labeled them as 1, 2, and 3. So when I put a 1 in this red colored cell, that means that I'm using these 5-year average percentages to calculate the figures over here. All right. And so notice this formula, this is where the actual choose function goes. The data I was just showing you is actually the input to the choose function. So it says choose on the basis of what's in cell I2, which is right here. This is cell I2. And then we're going to choose, we're going to use that number to pick whether we look at column H, I, or J. And in this case, this is down in row 8. Let's go over here. See, there's row 8 right there. And so what this is going to do is it's going to look at that number, and then it's going to pick the column that is the same as that number, and it's going to use this 5% to calculate my cash value here. And then the other thing that to get the actual cash value, then I have to multiply it by cell K6 off of my income statement. Well, let's look at what K6 is. K6 is right over here. That's my revenue for 2025. That's 8.5 billion in revenue. These are all in millions. All right. So once I've done that, again, I have locked down this one. I've locked down both the row as well as the column, and that's because I always want to reference that cell. However, these 3 I'm letting the row change, but not the column. And likewise here, over here on income, I'm letting the row or the column change, but not the row. So then I can easily just copy this cell. Once I've got this formula written, all I have to do is copy it across like this. And now all of these are correct too. And again, this is referencing, notice here, it's still referencing I2 right here. And then it's looking at H8, I8, or J8, these guys. And then whichever one this one references, so it'll actually take H8 again. And then it'll multiply it by the revenue, which is over on the income statement in cell M6. So if I go back to the income statement, cell M6 is right here. It's the 2027 revenue.
Good question.
Uh-huh.
On the income statement for the 4% expected growth of revenue, is that something you calculated, or where did you come up?
I just picked a number out of the air so I could, when I'm looking at these things, make sure that it's sort of doing what I think it's doing. In fact, I should probably make it 10%. Oops, because then it'd be easier to see, you know, just quickly in your head, calculate, hey, does that look like a 10% increase? But I've made them so that I can change them. And I'm glad you asked that question, Hayden, because this is helpful where one person, say, is building the spreadsheet and another person is working on calculating the growth rate. You don't have, the spreadsheet person doesn't have to wait on the person calculating growth rate in order to actually build the spreadsheet. Once I've got the actual growth rate that I want to use, I plug it right in here, and you know I can make it whatever I want. Does that make sense?
Yeah, thank you.
Sure. Yeah, good question. And by the way, I happen to have chosen to do this to allow me to do a different growth rate for each year. But that's not really necessary. When I build a spreadsheet, though, I like to be able to build it so that I can very easily adapt it to another situation. So I might use this same spreadsheet for another company. And now maybe Smucker, I mean, you all are just going to come up with one growth rate. Maybe two, depends on what you think about the company. Maybe you think there's going to be slow growth for the first few years and it'll speed up, or vice versa, or something like that. That's totally up to you. But this kind of formula, or this kind of format, gives me the flexibility to be able to change that around with ease. And by the way, this all feeds, basically everything is driven off of these growth rates. Right? I make one change to the growth rate and all of the numbers are going to shift around. And the same with the balance sheet. The balance sheet is going to shift around as well at the same time. So I don't do anything related to revenue growth on the balance sheet, only on the income statement. But notice, let's see, I've got $492 million in cash there in fiscal year 2027. If I change this growth rate up and play around with it, then of course that number changes as well. Jumps up to 628. So yeah, I try to build flexibility into this. Let's see, let me shift this back to 5% across the board. And let's see. All right, so now we've got all of these accounts that spontaneously change with revenues. So we've got our all of our income statement accounts change with revenues. And so you'll notice I'm using that choose function only for the actual accounts, not for the subtotals. So here I've got actual subtotals as opposed to a percent of revenue, just like I did on the historical ones. I mean, in truth, you really don't have to change these to subtotals. It's really these that are important, that those are truly subtotals as opposed to just a percent of sales. And then here's my operating expenses. Again, that goes back to the choose function because that's a percent of sales. And in this case, I've chosen to use the 5-year average. If I change it to the 2-year average, oops, that wasn't right. I just want 2, not 2-year. You'll notice how the numbers shift around a little bit. Not a lot, because these averages are pretty stable across all 3 of the assumptions that I've made here under this. You go back to 1 year. All right. Everybody okay otherwise up to this point? Yeah. Now, so I've up to this point, I've already filled these in, but really what we've talked about is just the stuff that varies with the percent of sales. Now, let's go on to talk about the things that don't vary as a percent of sales. So here I have my long-term assets, my plant, property, and equipment. And again, I've consolidated it a bit. I've still left the net account and then the 2 sub-accounts, which is PPE gross and accumulated depreciation. And so all of those are there. But notice that this this account is actually the sum. Well, actually, it's PPE gross minus accumulated depreciation. Right there. And I've continued with that same model here. One little change though. What I'm doing here is up at the top of my balance sheet, I've got the ability to change my assumed plant, property, and equipment. So this one is a little tricky, right? Because we want to be able to have some flexibility in that so that we can make it match what we think the company is going to do, not knowing exactly when PPE is going to change, right? To know that, we would truly have to know things like what's their current capacity, and is that capacity, can they run it all the way up to 100%, or do they start running into inefficiencies? Are they planning on building a new plant? Then I'd want to factor that in. If I know ahead of time that they're building a new plant, that's in the design phase and is almost certainly going to go through, then I'd put that in. But as it stands, I don't know that, but I can still build my spreadsheet. And I've made it easy for myself to be able to change what the plant, property, and equipment is, and the accumulated depreciation, or the addition to accumulated depreciation, I should say. I've only done this for one. I've used one set of cells so that it references all 5 forecasted years. Another way to do this would be to simply say, well, let me make assumptions about that for each year. And I could put my PPE additions here, and I could put my additions to accumulated depreciation here. So I could do the same thing that I did on my income statement related to the growth rate, right? So feel free to make that change if you think that that's going to be helpful and make your spreadsheet more flexible. In this particular case, I just chose to use one. And here I reference that in all these cells. Notice that this one over here also references that. So what I've done here is I'm increasing my gross PPE by 400 million every year. And then I'm also increasing my accumulated depreciation by 130 every year. Now, that's a bit of an assumption. I mean, that's not exactly what's going to happen. As I increase my PPE, my contribution to accumulated depreciation is probably going to rise a little bit. So you might even, like I said, you might even want to make this a different value for each year and put PPE here, accumulated depreciation here, PPE here for 2026, accumulated depreciation here, and then reference it down in these 2 cells. All right. And then, of course, this cell is just the PPE minus the accumulated depreciation. Be very careful about that. That's minus, not add. right? Some of these subtract from, right? So that's the net PPE right there. And then I go down here to other long-term assets. Well, what are those? I don't know. I mean, what I would suggest you do is to go back into the more detailed balance sheet and try to figure out what those are. Are we going to keep them about the same? Are they going to change a lot? It looks like for the first 3 years of our historical data, it looks like they've been relatively constant. Then a little bit of a decrease here, and then kind of a bump up above that constant level from the first 3 years. And I just made a gross assumption. I'm going to use that same value all the way out. And again, this might vary depending upon what you find when you go back. I haven't gone back to the detailed statements on the 10K to see exactly what's in this other long-term assets. That's something you should do, though, so that you know what's there. And is the assumption of just keeping that constant for the rest of the 5 years reasonable or not? If it is, fine. If it isn't, you can change it, right? So now I've taken care of all of my long-term assets. And so I want to get the total of long-term, or what they call here non-current assets. So here I'm just subtotaling, I'm just taking the net PPE and adding to it the other long-term assets, and that becomes my total non-current. And then finally, I add together my total current and total non-current, and I have my total assets. And notice that they're going up each year a little bit, not a lot. And again, largely that's because of the assumptions here about PPE. Okay, any questions up to this point? All right. Okay, so now let's go down and deal with 2 other things that we have to do. One of them is to close the retained earnings from the income statement and close them out to the balance sheet. Let's start with that. So I've highlighted this in a slightly different color to represent that, hey, this is a cell that is going to be changing based upon the income statement. And all of my retained earnings that I earned in prior years is accumulated in this account on the balance sheet, right? So no matter what I do, I'm going to be adding to whatever net income I have, positive or negative, gets added to this amount from 2024. So I'm starting off with retained earnings of $2.188 billion. This next year, the projected year, I'm going to use that same 2.188 billion, and I'm going to add to it the amount that I did not pay out in the form of dividends. All right, and that comes off of the income statement, cell K17, as you can see right up here. Okay, now, so that means I'm going to have to go back to my income statement and figure out how much am I paying out in dividends, right? So let's go do that exercise. So here we have, let's see. Let's go back to the historical. I'm going to scroll down a bit. And here we have dividends per share. This, by the way, this comes off of Bloomberg. So we've got dividends per share, and we have total cash common dividends. And this value is $3.52 per share is the dividend that was paid in fiscal year 2020, probably in 4 separate dividend payments, so 352 divided by 4. The next year they grew it by 8 cents, so it's 360. The next year they grew it by 36 cents, so 396, and so on down the line. To get this figure, it's simply the number of shares outstanding times the dividend per share. So that's a total, we paid out a total of 441 million in dividends for fiscal year 2024. So Bloomberg doesn't, in this particular account, Bloomberg doesn't tell us what shares outstanding are. I don't think, at least I didn't find it on here. Now, you could certainly grab that somewhere else if you wanted to. Oh, wait a minute. I take that back. They do. They have it right up here. Diluted weighted average shares. So that's actually shares outstanding in millions again. So 104.4 million shares outstanding on average in fiscal year 2024. I actually did that calculation on the basis of the dividend and the aggregate dividend payment, and I came up with a number very close to what they have. You could actually use that number up here. It's probably, in all honesty, it's probably a better number because it's an average across the year. But you'll notice how these line up with what I got down here. I just happened to use these in my calculations, though. All right. So we've got that. Now we have to project what are we going to do with our dividend. And again, I've just made this up. You will be taking a much deeper dive into the data and into what they've done and what they say they're going to do in the future. You might even get some percentage growth rates in the dividend and so forth. But what I've done here is I've just said, well, let's just use 450 because the most recent. Wait a minute, what did I do here? Not sure why I put this one in over here. I might have had it in the wrong spot. Nevertheless, it doesn't really matter for our purposes here for the how to build the spreadsheet. So in this case, let me just ignore this one. And in this case, let's assume that the dividend that gets paid in 2025 is $4.50. So that's a 26-cent increase over the prior dividend from year 2024. And so if I take that times the number of shares outstanding, right here, I get, I've got a mouse on my desktop screen, and I'm trying to use it, but I'm actually working on my laptop. So sorry. So I've got my formula. I've got the number of shares outstanding times the dividend per share, and then I'm dividing that whole thing by 1 million to get it back into scale. So that means that I have an aggregate dividend payment of $468.5 million for fiscal year 2025. Right now, I'm going to go up here. And right here, what I'm doing here is I'm taking the net income, the 842 in this case. Oops. Oh, whoa. Went a little bit too far on that. Come on back. Come on. All right. So I took the 842, and I subtracted from it the amount of the dividend. And so what I'm left with is the amount that actually goes into retained earnings. And that turns out to be $373 million in this case. I do the same thing here. I take the 889, subtract from that the 484.1, and now I have my retained earnings of 405. So note the cell. We're in cell K17 over here, right? So that's going to be my addition to the retained earnings account on the balance sheet. Notice that I'm adding to the prior retained earnings the income statement cell K17. So now that becomes my new retained earnings. And here, again, I'm taking the prior one out of K34, and I'm adding to it the retained earnings from the income statement, L17. So if I go back over here, here is L17. And again, that one is also the net income minus the amount of the dividend here, the aggregate amount. All right. Questions on any of that? I do that for the rest of the 5-year, the entire forecasted period. So now I've got a retained earnings. Now I have to make some assumptions again about this other equity account. It looks pretty stable. I don't know what's in it. I want you all to know what's in it. But for exposition purposes, I've just picked a number and I've continued that throughout the next 5 years. It's not a big number. It's not terribly important. You as analysts should know what it is, but for our purposes, I'm just running it out across here. Now we still have share capital and APIC, that is additional paid-in capital. So those two accounts are made up of two sub-accounts, or that account is made up of two sub-accounts. That's the common stock and then the APIC, the additional paid-in capital. So common stock is what they call the par value of stock. Stock has always had some sort of par value. It's a very old concept that was used originally to try to give people who were unfamiliar with capitalism and corporate ownership style, form of ownership. And it was to give them a little bit of confidence that the value of their shares actually had some value. So they set a par value, which sort of implied that they would guarantee you that sort of payment if the company went belly up. I don't know whether that actually really worked historically, but today that's just complete fiction. There is no real guarantee attributed to that. And many times par value, instead of being $1 or $10 a share, is actually fractions of a penny per share. But we still keep that account around for some reason. The accountants are reticent to get rid of it. So in this case, that has very small dollar amounts in it, only 26 million. The bulk of it gets dumped into, so anything that gets paid for the shares above and beyond par value gets dumped into APIC. And then the sum of those two is this account, this higher level account called share capital plus APIC. So we're actually just going to use the share capital plus APIC, even though in truth, if we were to issue more equity, which it looks like we're not, we're actually decreasing our equity, the way I've got the model built anyway at this point. But if we were to issue more equity, some of it, a little bit would go into that common stock par value account, and then the rest would go into the APIC account. But over here, what I've done is I've just said I'm just going to take that higher level account and deal with it. Now, this account plus my long-term debt account and even to some degree my short-term debt could be used for this, but in my case, I'm just using long-term debt and share capital. Those are my what we call plug accounts. And what that does is that allows us to force the balance sheet to balance without us doing anything to it. So if I were, for instance, to go over here to the income statement, let's take a look at before we go, let's take a look at our total assets here. It's 20.848 billion, all right? Now, if I were to go over to, and I want my liabilities and equities to equal 20.848 billion, right? And at this point they do. Now, if I were to go over here onto the income statement and change my assumptions for growth, let's make that 20% growth instead of 5, that's probably going to change the world a little bit for my model. Notice that liabilities and equities have gone up to 21.173 billion. But I want a balance sheet that balances, and oh, well, look, my total assets are also 21.173, even though not all of these accounts move spontaneously with revenue, right? These don't. and many of these down here don't. But everything still balances. By the way, up here, I've just got the difference between total assets and total liabilities and equity, so I can check and make sure that all of those accounts balance no matter what I do to my spreadsheet and my assumptions. So even if I were to say change this to, I don't know, 700 million, the numbers again down here changed, but they all still balance. That's still zero, and so forth. And that's because of these two plug accounts. These two plug accounts force the balance. All right. So we've got all our other numbers. I think one I didn't mention. Here again, under say other long-term liabilities. This is mainly taxes. I looked at it beforehand, before I removed the sub-accounts. So I just made myself a note here. And notice that, this tax liability remains relatively constant over time. So I'm actually going to take it as a constant and just use it as a constant throughout all 5 projected years. The same thing with other short-term liabilities. I'm just letting that grow with revenues. I'm also letting short-term debt grow with revenues. Not an assumption you necessarily have to make if you think the company is doing something different, but it's the one that I made in this particular spreadsheet. All right, so now I've got all of my accounts except for long-term debt and long-term equity, or common equity, share capital. All right. So the formula here is important. So what I've done prior to writing these formulas, I've also gone over here and I've gotten my approximate debt to asset ratio. Notice here I've looked at fiscal year 2024, and I've got total liabilities divided by total assets. So it's the total amount of debt, both short-term and long-term, that's on my balance sheet as of 2024. Now, I just went with that number. I would recommend strongly, though, to you all that you look back historically and see what that number's been over the prior 4 years beyond 2024, before 2024. And also read the 10K management discussion and any other earnings calls, things like that. Anything else that can give you a sense, does Smucker's executive team think that the debt level is too high, too low, or just about right? Remember, we're not consultants. We're trying to reflect what we think management is going to do. And so we need to figure out, we need to read everything they write about leverage and debt. Why is debt where it is? If you all think back to when Mike McFall was talking last Thursday about why his company doesn't have a heck of a lot of debt, and each company is different, different decisions made by the management team. So as of 2024, their debt level was 62.05% liabilities. The balance of it, that other 38%, or just a hair less, was equity. All right. And again, I'm going to make the assumption that all of the leverage going forward remains at 62.05%. That's not the assumption you should necessarily make. I want you to do a deeper dive on what you expect Smucker to do, right? But I'm going to show you, just for expositional purposes, I'm going to show you assuming that it's always 62.05%. Now, you could do a different leverage for each year if you wanted to. And again, you could put that, instead of up here, you could put it, right along with the year. And same thing with your PPE and your accumulated depreciation. So you could have all 3 of these cells filled with, PPE, accumulated depreciation, and then leverage. Again, in my case, I just chose I'm going to use this leverage throughout the 5 forecasted years. So when I come down here to calculate my long-term debt, my goal here is to make the amount of long-term debt equal to the difference between 62.05% of assets and all of the other liability accounts. So in other words, it's going to make that total liability equal exactly 62.05% of assets. So here's the formula that does that. Oops, again, I'm using my wrong mouse. Here's the formula that does that. So notice what I'm doing here is I'm taking Q1, which happens to be that cell where I've got the debt to asset or the liability to asset ratio. So that's 0.6205 multiplied by K20. Now that is the total assets for fiscal year 2025. And then I subtract from that K26 and K28. Well, K26 is total short-term liabilities or current liabilities right here. And K28 is other long-term liabilities. So actually I've accounted for all of the liability accounts. I've got everything above this is here. And then the only other liability account is here. So when I subtract those two off, I'm basically forcing this long-term debt, this 8.489 is exactly the difference between 21,473 minus 2,942 minus 1,893. And so that means that my total liabilities are always going to sum to exactly 62.05% of my total assets. Make sense? I do the exact same thing with equity, except here I want it to be 1 minus that leverage ratio, right? So here I've got 1 minus Q1, so 1 minus 0.6205 is 0.3795. Again, times my total assets. And then I subtract off any of the other equity accounts that are already there, and that's K34 and 35. K34 is my retained earnings, and K35 is my other equity. So I've subtracted off those two amounts, and I end up with 8.149 as my total equity account. And then the sum of those two is going to add up to be exactly the 21,473. All right? Any questions on that? I've covered a lot of ground, but anyone? All right. We've got one last step here, and we'll be done with this. So we have a net income projected all the way out here to fiscal year 2029. All right, and so here's our net income, and then we have balance sheets that all balance no matter what we do with our growth rates or our other assumptions embedded in here. You know, I can change this around to anything I want. I might change it to, say, 50%. And notice that, you know, this changes my long-term debt versus my common equity. I'm going to change that back to 62.05. Now, so the last step here is now I need to get my free cash flow to equity, and I need to calculate a terminal value. I need to take all of that, and I need to discount it back to today at K, and then finally I'm going to divide that value by the total shares outstanding. I'm going to have a price per share using DCF. All right, so that's step 4 on my spreadsheets, and oops, again, I'm doing the wrong mouse. And step 4 is right here, and it did open up. Great. All right, so step 4 has everything that we built on step 3 spreadsheet. In addition to that, I've got this area down here. And so I put this under the income statement. It could go anywhere. I mean, whatever is convenient for you, but because we're pulling net income off of there, and because it is really our cash flows, I just thought it'd be better on the income statement. So here I'm using the information off of the Wall Street Mojo website. And that website is really handy for how to actually do this calculation. But for that calculation, I'm going to need my net income, I'm going to need my depreciation, my change in net working capital, my CapEx, and my net borrowing. Between those items, those 5 items, I'll be able to calculate the free cash flow to equity. And I can't emphasize and underline that enough, because in the book, in chapter 6, they calculate free cash flow to the firm, not to equity. To the firm, it's including the interest that gets paid to the debt too. So when we get that value, we have to subtract off the market value of the debt. Well, not unlike many other companies, Smucker has some long-term debt, and they have numerous bond issues, and we'd actually have to go out and get the market value for each of those, not the face value, the market value. So it's much easier to actually implement this formula. The only difference between the formula we used in the book and the formula we're using here is this net borrowing. That's the key difference, and that allows us to actually calculate the cash flows that are due to equity only, not to equity plus bondholders. All right, so let me first show you the website. Let me get to Canvas first here. So if you go to the assignment, scroll down to the FAQs. I think it's at the top of the second page of the FAQs right here. Yeah. And why is this not giving me? It's a bummer. It's not giving me the link. Let's see, where do I want to go from here? Let me go back to Dropbox and 342, security analysis, and here we are. This is the same assignment. It's just that the link wasn't live on the Canvas. So I go to the FAQs, and right here, this link to wallstreetmojo.com. By the way, everything I've seen on this site is pretty decent. They've got a fee-based part of it, but they also have a lot of free information, and the free stuff that I've seen is great. It looks like they employ a number of CFAs, so this is a website that I think you can depend on. So this particular link takes us to the page where they talk about free cash flow to equity, what it is, the importance of it, so kind of overview stuff. But the real nice part about this is that, come on. Once you get through all the pop-up crap, here we are down at the formula. So free cash flow to equity, net income plus non-cash charges plus changes in net working capital minus CapEx plus net borrowing. So this non-cash is actually depreciation, right? And then here's some comments about each of the accounts. Here are some alternative starting points. So we don't always have to start with net income. We could start with EBIT and still get there. ultimately, you still end up at free cash flow to equity. Then a bit more detail about each of these elements, some examples, and then they actually show you on a spreadsheet how to actually do this. Literally, get the net income, find a depreciation. How do you get changes in net working capital? Well, you've got to take, notice their years are reversed here. So the leftmost column is the most recent year. And so you've got to take the working capital for the most recent year, which is accounts receivable plus inventory minus payables, and subtract from that the working capital from the prior year, accounts receivable, inventory, minus accounts payable, and that's the change, right? So you've got to have all 6 of those cells referenced in the proper way, and notice they actually give you the formula right here from that spreadsheet that they show you. So it's a really detailed, step-by-step way of calculating free cash flow to equity. So I have taken advantage of that, and I've used that so that you can follow along that using that website and your spreadsheet. So here I've gone up and I've taken my net income. And by the way, these should still be all cellular cell references, right? Formulas. Don't hard code anything unless you absolutely have to, right? Make things reference everything else so that when you change one part of your spreadsheet, like the growth assumptions or the K, everything updates. You don't have to go back in and go, oh, wait a minute, I hard coded this number in so it's not updating my free cash flow. Well, why would you hard code that in? Just make it a formula. That's why we have spreadsheets, right? I say that only because I've seen that happen so many times on prior assignments. But make sure these are all formulas. So this particular one just references net income right up above it. Then we go down here to depreciation. Oops. What is the depreciation? Well, we know what it is because we set it up to be this, but it's K17 minus G17. Well, what is K17? And this is over on the balance sheet. K17 happens to be my accumulated depreciation, and G17 happens to be my prior year's accumulated depreciation. So it's that difference right there. That turns out to be 131 or 130 million. I do the same thing for the subsequent years. Now, obviously, I actually had to write these formulas for this column for the 2025 data, and then I had to write these for the 2026 data. But once I got those written, I could then copy it over for the last 3 years, right? The reason is that, for instance, when I'm using getting the values for 2025, I'm going back, I'm skipping over these 3 columns, and I've got to go 4 columns to the left. This one, when I'm calculating values, I only have to go 1 column to the left. And the same thing with these, just 1 column to the left. So I have to write the formula for the first 2 years separately. And then once I've got this, all I have to do is copy it across. Actually, all the way across, sorry. Right. Down here, change in net working capital. That one, notice the formula. So I've got my accounts receivable plus my inventory minus my accounts payable. That's what K9, K10, and K23 are. Now that's my net working capital for fiscal year 2025. I subtract from that my net working capital for fiscal year 2024, which happens to be G9, G10, that's accounts receivable and inventory again. And then over here, G minus G23, that's my accounts payable. All right. So now I've got my net change in net working capital, my change in CapEx, or rather, I shouldn't say change in, my CapEx is simply the amount of spending that I have and how my gross plant, property, and equipment has changed in value, and that turns out to be that 400, but it's also K16 minus G16. And then over here, it's L16 minus K16, and so forth. And then finally, net borrowing is both the short-term and the long-term debt changes. So here I have my new short-term debt plus long-term debt for 2025 minus the short-term debt and the long-term debt for 2024. And that becomes my net borrowing. So I borrowed $645 million in 2025. Now, finally, my formula for net working capital. I take my net income and let's go back up here. I take my net income, which is K19, and I add to that, I added back the non-cash expenses, depreciation in this case, out of K20. I subtract the increase in net working capital. I also subtract the increase in plant, property, and equipment, the CapEx, and I add the net borrowings. And then that becomes my free cash flow to equity. It's that simple. Questions on any of that so far? Everybody still with me? I only see a few. I haven't seen the whole class. Okay, good. All right, we're almost there. Not too far away. Now we just need to get a discounted value for those guys, get a terminal value for the company, and then finally get a price per share. All right. So now I have free cash flow for all 5 years that I'm projecting out into the future. So I've got a 1.148 billion, 1.038 billion, 1.121, 1.201, and 1.294. Now, I get a discounted value for those. And that discounted value is simply taking, in this case, the 1.294 and discounting it at my discount rate, my K, for 5 years. So I'm going to take that. Notice here I've got, here's my K down here in cell K26. Here is my exponent, right? I put my number of years up here, so I'd have them handy. So I'm raising it to the power of 5, that 18 is my power. And my growth rate is, there's my K. The K also happens to be in column K, K26. And then here is my nominal free cash flow in fiscal year 2029. So that means that 1.294 billion is actually worth 768 million today. I do the same thing for all the other 4 years. All right, using this K. And again, if you're working on a spreadsheet and one of your teammates is working on K, you don't need their K yet. But just make sure that whatever K you have is always referencing the same cell. So my K for everything is going to be the K that's in cell K26. If you start with a simple number and your teammate says, "Oh, I've got the K. It's actually 10%." I can easily change it, and all of my present values change as well. So again, try to keep things flexible. Try to keep them, orderly. All right, now we've got discounted cash flows. The trouble is that we only have 5 years though, and the company we assume is going to go on producing goods for an unknown length of time out into the future. So we still need to know what happens in years 6, 7, 8, 9, 10, 11, 12, 20, 30, 40. But it's pointless in trying to project out that far in this level of detail. I mean, It's even going out a couple of years is a real challenge. Going out 10 or 20 years with a pro forma, it's ridiculous. It's pointless. So many other things can change over that length of time. So what we're going to do is we're going to just say, hey, everything from year 5 or beyond year 5 and out, we're going to sum that up in this terminal value. So where does this thing come from? Well, we've got really two main choices. We can use a fundamental valuation technique like the dividend discount model. We could use the free cash flow model. We could use any other fundamental valuation technique. You could use residual income. Or we could use a relative valuation metric like PE is often used, or price to cash flow can get used. I chose in this example to use a one-period dividend discount model. And so what I did here was I said, well, let me take my projected dividend, and that is, I've got 0.42 is my dividend. I'm going to project it to grow at a growth rate that I'm actually using up here. Let me go back down here and show you. Oh, wait a minute. I take that back. Where is, oh, whoops, went the wrong way. Come on back. Oh, sorry. Here, I put it down here. All right. All right. So let me start over with this. So this terminal value, I've chosen to use the dividend discount model, constant perpetual growth version. So it's basically D1 over K minus G, right? Now, what's D1 in this case? Actually, D1 is the dividend that will be paid in 2030. Now, I know what the dividend, or I assume I know what the dividend was in 2029. It was $5.15 per share, or a total of $536 million. So I use that and I grow it by some rate. And in this case, I've assumed a growth rate of 3%. Very modest, but this is not a tech company. This is not a startup. It's not going to grow at double digits. It's going to grow at about the rate of the economy, GDP. On average, grows about 3%. So that's why I'm just picking 3%. And remember, while this value is important because it really is the vast majority of the value of the company, it is also, it's so far out there that we really don't have a great idea of what it is. So using some very conservative assumptions is fine. So I'm going to grow that dividend at 3% to get my dividend in fiscal year 2030. And then I'm going to take that dividend. So if I come up here, here's my 2029 dividend in cell 042. Here's my growth rate of 3% in cell 043. So I've grown it to be the dividend at the fiscal year 2030. Then I divide that by K, which is in cell K26, minus G, which is again in cell 43, not 0. When I do that, I come up with the value of the company is $7.889 billion as an ongoing affair at the end of 2029. So that's the same time I receive that dividend. I'm assuming all these dividends occur at the end of the year, which I know is not entirely accurate, but again, we're approximating a lot of things here. All right, so approximately 7.9 billion as an ongoing firm, and that's timed at about the same time I receive this dividend. So now I can add those together, and hang on a second here. I don't think I took care of everything properly here. Yep. This was the last thing I did, and I thought I was done, and I wasn't. So note that this $7.9 billion is the value as of the end of 2029. So I still have to take a present value for that. I have to get it back to time 0. And I didn't do that in this formula. So what I am going to do, let's see, why don't I do it in a separate row? I'm going to take this stuff and I'm going to move it down one row. And then I'm going to calculate the new discounted terminal value. So I'm going to take that, divide it by 1 plus my k raised to the 5th power. I'm going to go up here and pick this cell. And so the present value of that terminal value is about 4.9 billion. And let's see, let's make the colors all match up here, nice and pretty. Oops, not so pretty. What was that color? Was it that? I guess so. Yeah. All right. So now I've got the present value, and I need to make a change to this formula too. This one should say 28, not 27. All right. Okay. Sorry about that. Does everybody see that where this number comes from? So this value here at the end of 2029 is the present value of the dividend plus the terminal value. They both occur at more or less the same time, one instant after the other. And so the sum of that is 5.7 billion. And then the prior 4 years, I have cash flows for those that amount to 821, 842, 858 million, and then over here just a bit more than 1 billion. Now here I'm adding them all up. So I have an aggregate value of 9.267 billion. And then finally, I'm dividing that by the number of shares outstanding. And that came from down here, this 104 million shares outstanding. When I do that, I get a share price of $89. And I might want to just go over here real quick and take a peek at Yahoo Finance. And we see that SJM is currently trading at about $115. Is that far below, is that truly different or not? I don't know. All of my assumptions are not your assumptions. So I'm not making any judgment calls here. I've just used some numbers that many of them I've just made up. But yours will be not made up. They will be after thoughtful reflection upon the industry outlook, the economic outlook, what the management team says they're going to be doing in the future, and all of those things are going to be embedded in yours. So your dollar value may be much higher or much lower than mine. But this is what I happen to have gotten for that answer. And then we're done with our pro forma. We've got our DCF, we've got our free cash flows to equity, discounted them all, we've got our terminal value. This is what I hope to see from all of your spreadsheets.